In this video, I'm going to talk about the longer the range, the bigger the move. Stay tuned. Hey traders, a very warm welcome to you. Okay, so this is a generalization, but it happens more often than not. When price has been stuck in a range for a long period of time, let's say that's a couple of years on a daily chart, when eventually we break out, this thing will likely go a long way. We've seen that with various markets, and the yen is the biggest one that springs to mind. Many years ago, when we kind of broke out of that range, and it just went. And now this is, why does this happen? This is what I want to examine today in this video, and also want to kind of pinpoint why we should be looking at these ranges and how we can prepare ourselves for these breaks out of ranges. Now, whenever you're watching this, there may well be a handful of stocks, handful of markets, handful of currency pairs that are in these kind of ranges. And so being prepared for the trade is what it's all about. So why does this happen? At the end of the day, if we've got a 2-year period here and we've been chugging highs, chugging lows, and we've not done anything, it generally means there's not been any reason for buyers to pay more than this, any reason for sellers to sell more. It's been an accepted level. And generally speaking, that's because perhaps there's no catalyst, there's no earnings growth in the company, there's nothing new in the economy, there's nothing, nothing a change of interest rates. There's nothing to say to someone or any bunch of traders or enough traders to move it that, hey, this potentially has been revalued now. We've had this as a definition of value all throughout this 2-year period, but no one really believes that it's worth significantly more than that or significantly less, which is why we're just kind of ping-ponging back and forth as the money flows in and money flows out. People would speculate one way or another. So that's one reason. The second reason why we get these bigger moves is that it's often like pushing people through into a kind of small room. The bigger the time we've got to push people into this small room, when you suddenly open the door, you've got more people in the room who want to push out of the room. So what I mean by that is that people are speculating whether it's going to go long, whether it's going to go short. And that's the ultimate reason why people are trading this. Sure, we might have some people trading that range, but a lot of people are going to have analysis that says, you know what, this market's going to go up to here, or this market's going to go down to here. And they'll be sitting with it for a long time and then all be watching it. So that's that. And the final thing is, when we do break, every single person under the sun will be watching it. That will be headline news because it'll be multi-year lows. Every trader in here, like I say, into that small room will be looking at it. Shorts will be happy and probably adding. Longs will have most likely have their stop under there because that's the obvious place to put it. And there is most likely as well going to be, at the initial point, a catalyst for this. There's going to be something that comes out that gives us this catalyst. And it might be, an interest rate announcement. It might be jobs number. It might be earnings, whatever it may be. But there'll likely be something. So we get, not only do we get the catalyst, we get people who have been in this trade for a long time who are now going to either exit if they're wrong, which is probably going to add fuel to the fire. We're having other traders looking at it because it's going to be headline news. It's going to be flagging up on people's alerts and stuff. It's multi-year lows. You're going to see it all over the media. So that's number 3. And so this combination generally is going to lead to a big move out of that range. And we've seen this many times over the years. Go back and look at all your charts and see if you can spot some of these kind of things. But very often, this is what happens. So to be prepared for it, what do we do? Now, we could just do the classic thing of selling the break of that. We've got to be careful of that because very often we're going to get little teasers, little tests, outside of the range that come back in, and we don't really want to be getting pinged out all the time. If it's true momentum, you're going to get a rocket off in one direction. I've done the downside here, but let's go over here and imagine we've got to the upside. We're going to get a rocket off in one direction, but we're going to get a pause of some sort. And our job as traders is to identify what that pause is going to be. Classic bull flag that if you're a subscriber, I love the old bull flag trade. Or is it going to pull back to a moving average that pushes up? Something. We don't have to be so carried away of jumping on that initial impulse. If it's genuine and it's a good momentum trade and it's explosive and it's coming out of the range, we're going to get one of these. And so being prepared for it and waiting to say, let it go. Let's see how it behaves on its first kind of supply-demand imbalance, neutral position or shift. if there's still buyers keen and we get, kind of really tight flagging or even kind of sloping down flag that breaks straight away, we want to be on that, and we can use our traditional methods for getting in, where we go bullish engulfing, trend line break where they have a wick here, and manage our risk with a stop kind of under here. But as we talked about before, adding the layer's edge within this whole scenario of a big multi-year range finally breaking. And then, this is the thing we've got to be looking for, guys, is to hold this thing for as long as we can. Because if this multi-year range is broken and we've got all those reasons for it to potentially break, this could be the trade, a really, really serious trade. We're not talking about taking out 25 pips out of this thing. We're looking at this running on for many, many months potentially. So, knowing the difference between the two types of trades as well. Does it always happen? Of course it doesn't. So we've got to have a risk manager at some point or another. But, generally speaking, the longer the range, the bigger the move. So that's really why we get that. And also being prepared for it, being alerted, and not being frightened of kind of buying too high. If this rips off really significantly before pulling back, just look at it from a subjective perspective. Don't kind of overthink it and say, well, it's way above the range. This thing could go on and on. So anyway, guys, that's that. Longer range, bigger moves. Hope you enjoyed the video. Thumbs up if you did. See you in the next one. Goodbye.